Welcome back. This is the weekly crypto and finance background recap for the upcoming week of June 8, 2026. This is educational market commentary only, not financial advice, and it is not a buy or sell recommendation. The big story is simple: traditional markets and crypto are sending different signals. US stocks ended the week under pressure after a strong jobs report pushed yields higher and forced investors to rethink the Federal Reserve path. Crypto had an even rougher week, with Bitcoin and Ethereum hit by ETF outflows, liquidations, and a broader reset in risk appetite. Let's start with the financial market backdrop. On Friday, the S&P 500 fell 2.6%, the Nasdaq dropped 4.2%, and the Dow lost about 695 points. For the full week, the Nasdaq was down about 4.7%, the S&P 500 lost 2.6%, and the Dow was down only about 0.3%. That split matters because the weakness was concentrated in higher duration, technology-heavy areas of the market. The trigger was the May jobs report. Employers added 172,000 jobs, roughly double what forecasters expected. Normally, strong employment is good news. But in this market, it also means the Federal Reserve may have less room to cut rates, and some investors are even pricing the risk that policy could stay restrictive for longer. Treasury yields moved higher after the report, and that hit stocks, bonds, gold, and Bitcoin at the same time. So the first theme for the upcoming week is the rate reset. Markets are not only asking whether the economy is strong. They are asking whether strength is inflationary. If employment stays firm, services activity remains resilient, and price pressure does not cool, risk assets can struggle even when corporate earnings are decent. That is the environment crypto has to trade inside. Now let's move to crypto. By Friday evening, Bitcoin was quoted around $59,270, down nearly 7% over 24 hours in one market recap. Ether was near $1,549, down more than 12% over the same window. The exact price will move by the time you watch this, but the message is clear: the market broke lower, and Bitcoin lost the confidence zone traders had been watching. ETF flows were the center of the damage. CoinDesk reported that spot Bitcoin ETFs had seen a record 10 straight days of net outflows totaling about $2.97 billion. Other weekly summaries pointed to hundreds of millions leaving Bitcoin and Ethereum funds during the first week of June, with leveraged liquidations accelerating the move. This is why the ETF story matters. In a strong market, ETF access can deepen demand. In a weak market, ETF redemptions become a visible pressure valve. That leads to the second theme: institutional demand needs to stabilize. Bitcoin does not have to instantly reclaim every lost level. But if outflows continue, rallies may be sold into. If outflows slow, and derivatives positioning stays calm, the market can begin to rebuild. For the upcoming week, watch flows first and opinion second. The third theme is the Bitcoin treasury trade. Strategy, formerly MicroStrategy, has become one of the most important corporate Bitcoin symbols. Investing News reported that Strategy was facing an $11.2 billion unrealized Bitcoin loss as its large treasury position sat below its average cost basis, and that the firm had sold a small amount of Bitcoin to fund preferred stock dividends. The exact accounting details matter less than the signal: corporate Bitcoin balance sheets are now part of market psychology. If Bitcoin stabilizes, treasury companies look bold. If Bitcoin keeps falling, the market starts asking about balance sheet pressure, financing costs, and forced behavior. That does not mean a crisis is guaranteed. It means the narrative has shifted from pure accumulation to stress testing. The fourth theme is the AI and infrastructure split. While crypto struggled, investors still showed appetite for parts of the AI infrastructure story. Hut 8, a Bitcoin miner turned data center operator, attracted major demand for a bond sale tied to a Texas data center project leased to a major semiconductor customer, according to Investing News. That is important because it shows capital is not abandoning technology risk entirely. It is becoming more selective. This is one of the biggest stories for the rest of June. Markets may still reward companies tied to AI infrastructure, data centers, power, chips, and tokenized finance. But they may punish assets that rely mostly on liquidity, leverage, or speculative flows. That is why crypto needs more than hype right now. It needs durable demand. The fifth theme is policy and market structure. Lawmakers are looking at prediction markets, crypto-adjacent trading, and restrictions around public officials. At the same time, major banks are exploring tokenized deposit networks, while tokenized securities and real-world asset products continue to grow. This is the strange part of the current market: prices can fall while infrastructure keeps developing. That is not a contradiction. Markets often sell the liquid assets first, even while long-term rails are being built underneath. For viewers, the lesson is to separate adoption from timing. Blockchain rails, tokenized deposits, ETF wrappers, and regulated derivatives may be long-term positives. But they do not stop short-term drawdowns when liquidity tightens. The sixth theme is security and trust. Zcash came under pressure after disclosure of a serious bug that reportedly went undetected for years and could have allowed counterfeit tokens before it was fixed. Arthur Hayes said he liquidated related positions. Whether or not a viewer owns Zcash is not the point. The point is that protocol risk is real. Crypto investors are not only taking price risk. They are taking custody risk, bridge risk, smart contract risk, governance risk, and sometimes unknown code risk. For the upcoming week, here is the practical watch list. First, watch treasury yields. If the 10-year yield keeps rising, it tightens financial conditions and can pressure both high-growth stocks and crypto. Second, watch Fed messaging. Any comment that reinforces higher-for-longer policy can keep risk appetite defensive. Any sign that inflation is cooling without economic damage can help markets breathe. Third, watch Bitcoin ETF flows. Stabilization would be constructive. Another wave of large redemptions would keep Bitcoin vulnerable. Fourth, watch the Bitcoin levels around 60,000, then the mid-60s. Reclaiming lost ground with improving flows is different from a weak bounce on short covering. Fifth, watch Ethereum. Ether underperformance matters because it tells us whether this is only a Bitcoin ETF story or a broader crypto demand problem. Sixth, watch AI-linked stocks and data center names. If those hold up while crypto sells off, the market is still funding infrastructure growth, but not broad speculation. Seventh, watch stablecoins, tokenized deposits, and real-world asset headlines. Those are the areas where traditional finance and crypto may continue converging even during a price correction. So what is the bottom line? The upcoming week is a confidence test. The bullish case is that ETF outflows slow, yields calm down, Bitcoin reclaims key levels, and investors treat the sell-off as a reset rather than a breakdown. The bearish case is that strong data keeps the Fed restrictive, yields rise again, ETF redemptions continue, and forced selling turns a correction into a deeper risk-off move. My read is cautious, not panicked. Crypto is wounded, but not irrelevant. Financial markets are nervous, but not broken. The important thing is to stop treating every dip as automatically bullish and every sell-off as the end of the cycle. This is a week for evidence. Watch flows, yields, and market breadth. Let the data confirm the narrative before trusting the headline. Again, this is educational commentary only, not financial advice. Stay disciplined, manage risk carefully, and I'll keep tracking the macro, ETF, and crypto market structure signals as the week develops.